Great. Good morning, everyone, and once again, welcome to this highly anticipated session on the union budget. The budget got presented over the weekend and has introduced several measures aimed at stimulating the economic growth, supporting various sectors, providing tax relief to a lot of taxpayers. So today, we have with us, and we have the privilege of hearing from one of the most insightful voices in the industry on markets, on economy, and business at large. Someone who has not only analyzed multiple businesses in multiple budget cycles, but has also shaped very interesting conversations around economic policies with his understanding and expertise and also foresight. So it's an honor to introduce Mr. Nilesh Shah. He's the managing director of Kotak AMC. He's also a key advisor to the Prime Minister's Economic Council and UIDAI. I'm sure we are in for a very enlightening session and a discussion on what this budget means from his point of view for businesses, for investors, individuals, economy, and for markets more specifically. So Nilesh bhai, welcome to this call. Thanks for taking time out on a Monday morning. So without further ado, maybe I will want to hand over the call to you, and we await to hear from you in terms of your insights on the budget. Thank you.
Thank you, Saurabh bhai, and very good morning to all of you. I'll be switching off my video so that the connectivity remains appropriate.
Sure, not a problem. Please.
If we look at the budget, it's a budget which is giving a signal that government is now focused on both supply side measures as well as demand side measures for stimulating economy. In last 10 years, government's focus was on building infrastructure, build roads so that goods from Chennai to Delhi and Kutch to Kashmir can move quickly. They built power plants so that power is available. They focused on renewable energy so global climate can be managed. Now they have realized that there is a need to boost urban consumption as impact of inflation, taxation is hurting consumption. They have given much more than expected from 7 lakh rupee to 12 lakh rupee tax exemption, which will put about 1 lakh crore in the pockets of consumer. Now this is like lighting the fuse of the cracker. The fuse of 1 lakh crore is not good enough to move the $4 trillion economy. But this 1 lakh crore should create a multiplier effect, like the fuse bursting firecracker. Number one, this money is given to people who are more likely to spend than save. Number two, this money should be spent in India. If people go to spend this money in Singapore and Thailand and UK, we don't benefit. This money must be spent in domestic tourism, travel, entertainment, mobile phones, healthcare, and so on and so forth. Then we will witness full multiplier effect. The second, while focusing on demand side measures, supply side measures have not been ignored. This year, we couldn't spend 11,111 crore of capex. The number came well below by 1 lakh crore. But next year, the number is 11,20,000 crore, adjusted for inflation, similar to last year, similar to this year's budget. More importantly, government has put more money in the pockets of state, like 1,50,000 crore zero interest 50-year loan for capex, more devolution to state. Now, important thing is state should use this for capex and not for Ladli Behna scheme. So subject to Indian consumer spending money in India and Indian state spending money on capex, this budget will stimulate both demand and supply side measures, and hence growth target can be revised upwards. Will people revise it today? Answer is no. They will see the action on ground before taking a call. One more good thing in the budget is that this budget is investing for the future. About 25,000 crore are allocated for maritime development. We spend yearly 50 to 60 billion dollar on logistics costs. All our import cargoes and export cargoes move on other people's ships. The government is now putting 25,000 crore for shipbuilding activities. Will this bring result this year? Well, answer is no. We are not like China who can build a shipyard in 6 months. But will it lay foundation for shipbuilding activities over next 18 to 24 months? Answer is quite likely. The government is putting 20,000 crore fund into deep tech and product innovation. Now, will we create deep seek kind of AI? Answer is no. But this 20,000 crore rupee spent in public-private partnership can create many product innovation through our Jugaad engineering. This is step in the right direction. There is another 10,000 crore allocated for development of technology, again through public-private partnership by way of venture capital investment through SIDBI. Now, again, will this create a deep seek? Answer is no. But will it create startups like Zerodhas and the Zeptos and the Swiggies of the world? Answer is quite likely. So there is about 50 to 60,000 crore allocated for future investment for futuristic technology. We may not reap all the benefits this year, but it lays foundation. Now, this budget has also maintained path of fiscal prudence. This year, they could have spent more money to create growth, but instead they have focused on fiscal prudence. Next year also, they could have spent more money, but they realize government does not have capacity to spend money at a rapid pace, and hence they have focused on fiscal prudence. This will give confidence to foreign investors. If we are spending money on capex, on stimulating demand, and we are maintaining path of fiscal prudence, and the divestment amount has not increased substantially, then how are we raising money? Is there a catch? Well, there is no catch, but there are assumptions. This year we got lucky as rupee depreciated. RBI intervened heavily to support rupee, and in the process have earned money. The dollars they bought at 60, 70 rupee, they are selling at 80 rupee. And that's why there is a notional profit. There is a profit of 10 rupee. That money is paid by way of dividend to the government. This year's dividend income between RBI, between banks, between PSUs is almost 3,25,000 crore. So there is some bonanza on the dividend side. The second one is the assumption on taxation. This year, tax buoyancy is about 1.1 times. That means tax collection will grow at 1.1 times nominal GDP growth. Next year's assumption, after adjusting for 1 lakh crore tax rebate, is coming to roughly about 1.3x. Can the tax buoyancy go up? Well, it's an assumption. Whenever we have cut taxes, black money has shifted into main economy, into tax net, and hopefully 1.3x tax buoyancy could come through. So net, this budget is reasonable in terms of estimates, except the tax buoyancy number, but it can come through if people lap up the 12 lakh tax exemption and start declaring real income. Overall, this budget is reasonably good because it focuses on demand as well as supply creation. Next question comes, does that mean that markets will cheering up the budget? Will FPIs come back? Answer is unlikely. FPIs today are selling for variety of things, but majority are, one, they are exiting emerging market as an asset class. US markets have done exceptionally well. Last 10-year return is fairly attractive compared to emerging markets. And emerging markets led by China, which has 30% weight in emerging market, has done very, very poorly despite super performance from India. Now, investors are saying Why should we invest in emerging market? Let's get out of that asset class. Passive emerging market index funds, ETFs, are facing massive redemption, hundreds of billions of dollars. Undoubtedly, India also sees selling. The second impact is because of President Trump. He is saying America first, make America great again. Every American FPI wants to show to President Trump, look, we are bringing money into America. We are investing in America. And anyway, American market return is very good. So those guys are also selling emerging market, including India, to get into America. Between American FPI selling and passive fund selling emerging market, we see FPI selling to continue. This budget gives them confidence that India is on right track, but their selling is not driven by India's performance alone. Now, this is not to say that slowdown in economy from 8.2% to about 6.5%, earnings growth decelerating from 15% plus to 5% does not contribute. It does contribute, but that's minority. Majority is emerging market as an asset class exit by passive funds, and President Trump putting America first, resulting into American FPIs taking their money out. Will FPI continue to sell forever? Well, answer is no. As of today, India's weight in MSCI emerging market index is about 19%. FPI ownership in India is around somewhere 17%. So they are underweight India. And as and when this underweight keeps on increasing, they will be wary of exiting completely, because on a longer term basis, India still remains one of the most attractive market to invest. Shorter term markets are like voting machine. If people vote more, anything can happen. But over longer term, markets are like weighing machine. आपका weight machine पे दिखेगा ही दिखेगा. So right now, markets will be driven by flows. FPI flows are likely to be negative, and hence we believe markets will continue to remain on the correction mode. Now, what should we do? Should we also join the bandwagon and sell because FPIs are selling? Well, answer is no. Number one, right now FPIs are selling, but who knows when will they turn back because of their underweight. Second, our markets are fairly valued. It's not very expensive that we should book our profit. We should invest as long as we are equal weight to equity in our portfolio. We should remain invested if we have little overweight to large cap. We should remain invested if we are in reasonably valued sector. And we should remain invested if we have some cash to invest on correction and become overweight. Most importantly, last 5 years return was 20% plus. Going forward, that kind of return looks impossible. So invest with moderate return expectation. What kind of sectors to invest into? As I mentioned, go for large cap compared to small and mid cap, but marginally overweight large cap versus marginally underweight small and mid cap, not complete exodus. Focus on sectors like consumption, because government seems to be focusing on consumption. And within consumption, please remember, the guys who are earning from 7 lakh to 15 lakh rupee are more likely to spend because they are getting maximum tax benefit. These people are secured on roti, kapda, makan. So they are not going to buy additional soaps, additional detergents, additional vegetables, or additional pulses. They are more likely to spend going to Prayagraj for Mahakumbh. They will fly Indigo airline or Vistara airline rather than going by train. They may look to paint their house because they have waited for a while. They may go and replace their 100cc motorbike with 150cc motorbike. So focus will be on entertainment, tourism, travel, healthcare, and such kind of spending. So please focus on where this particular middle class is going to spend. Those consumer stocks looks very, very attractive. Another thing, uh, at this point of time, don't ignore asset allocation because gold and fixed income also look attractive from investment point of view. For the gold, central banks around the world are competing with Indian housewives to buy gold. And earlier, their mentality was different from Indian housewives. Our housewives were buying, but they were selling. Now they have joined mentality of our housewives. एक बार खरीद लिया तो बेचते नहीं है. Put together, central bank buying of gold, especially with tariff war unleashed by America, will push people to diversify their foreign exchange reserve. They will move from dollar assets to gold, and that will keep gold prices high. The second thing is on fixed income. In September 24, it was very clear that US Fed is going to cut rates. Today, thanks to President Trump, then uncertainty is behind. There is uncertainty ahead. There is no clarity like before that US interest rates are going down. Now, we still believe that with the massive debt which US has and with the kind of tariff war it is unleashing, at some point of time, Fed will be pushed to cut rates. It's an assumption, not a conviction, and we can change our view depending upon what President Trump does. But if I have to put money over 12 to 18 months, not today, over 12 to 18 months, I will say Fed will cut rates because US economy will not be able to bear such high burden of debt and such high interest rates. With our budget, which is fiscally prudent, the government of India has given roadmap to RBI to improve liquidity and cut rates. Put together, we believe Indian interest rates will come down over next 12 to 18 months, and hence buying long maturity debt will be appropriate to invest. So if I have to summarize, budget is good for economy, demand as well as supply stimulus, but market in the short term being voting machine will be driven by FPI outflows. FPIs are exiting emerging market as an asset class. India will continue to see some outflow. In this correction or consolidation, please buy reasonably valued larger caps and small and mid caps. Be marginal overweight large cap, marginal underweight small and mid cap. Focus on quality and invest with moderate return expectation. Last 5 years returns are unlikely to come. Keep watch on gold as well as debt as an asset class. Gold should get supported by central bank buying, and in debt, longer maturity will do well, especially as RBI starts cutting rate to support growth. That's all I had to say, Saurabh bhai, but happy to take questions.
Thank you, Nilesh. I think that was quite lucid and very well explained, simplified. Participants, I'll request you to type in your queries in the Q&A box, and we'll take it up with Nilesh bhai. By the time the queries sort of build up, maybe a couple of questions, maybe for the benefit of the larger audience. And maybe let's talk about debt a little bit more. So while borrowings numbers, if one were to look at gross borrowings for FY25 is expected to be around 14 to 15 lakh crore, and marginally higher than what we saw in FY25. While on the net borrowing side, we are much lower. If you look at the assumptions that the government perhaps has done, and this is what we've been reading or we've been hearing also that the assumptions on the revenue side, specifically on the income tax growth expectations, collections, also the STT number that's been projected, doesn't it look a little stretched and challenging? And then to that extent, do you expect some slippages? Because that brings me to the point that if long duration is the way to go, uh, will that have some impact, or do you see that again to be a very short-term noise sort of?
So STT collection is assumed at about 77,000 crore against 59,000 crore this year. मतलब ये तो गवर्नमेंट के लिए चल रहा है, 5-10 हजार करोड़ इधर उधर हो गया, किसी को कोई दिखेगा भी नहीं. But as I mentioned, the tax buoyancy number of 1.3 against current year of 1.1 is on the higher side. And here the assumption is that whenever we have raised exemption limit and lower taxes, people have complied. They have realized that there's no point in going into black money and keeping all the pressure. Technology is making life difficult. So they start paying taxes. So this is a call on Indians becoming more tax compliant. There are big whales outside of TaxNet, and hopefully they'll all start paying their fair share of taxes, and which is why it's possible that tax revenue could be higher than this year. But it's something which we will have to keep a watch. More importantly, the net borrowing program has remained around 11 lakh crore for last 5 years. That's a very, very positive number. And today, demand of banking sector, pension fund, insurance sector, mutual fund, and foreign portfolio investors is more than enough to accommodate this 11 lakh crore. Plus, RBI will cut rates and improve liquidity as fiscally prudent budget has come. Put all these things together, undoubtedly we will keep a watch on tax revenues. But even if assuming lower tax revenue growth, we think we will be in a position to manage borrowing program quite comfortably.
Sure, thanks. One question related to the entire focus that the budget seems to be putting on consumption or more money in the hands of people. There have been a lot of fun strategies, general allocations that we've seen in the market where people have invested over the last 2-3 years in capex oriented sectors, and a lot of them are trading at rich valuations. Is it going to be now a switch in your view? While you mentioned some sectors that could probably benefit from this more money in the hands of investors, but do you see that shift happening? Because it's not like they are not allocating to capex; it's just that the growth is not as much as we saw in the last few years. What's your take on that sense?
So again, Saurabh, it is not that government has abundant capex. The
Right.
overall growth, including grants and PSUs, will be 17%. And more importantly, this government, is fairly efficient in spending that money. Otherwise, our infrastructure would not have doubled in last 10 years. Roads, ports, highways. I mean, all things have doubled virtually in last 10 years.
Sure.
So in capex, keep a watch, be little selective, because in some capital goods companies, valuations are very high. But also keep a watch on consumption, because if government is going to give stimulus for consumption, and it does carry multiplier effect, if all the Indians decide to spend that money only in India, the multiplier effect, as Professor Krishnamurthy Subramaniam mentioned, could be 5 times more. Now, whether that happens or not, no one knows. But he has given a theoretical example. If spending velocity is about 80% and 20% is savings, we could see 5 growth in consumption because of this 1 lakh crore tax rebate given. So consumption is something which is going to get more spending, more lift, and hence it's worth focusing on sectors like airline, tourism, travel, healthcare, and education, where majority of this money is going to get spent.
Sure. Few questions that have come up in the queue, and since we are on the topic of sectors, some of the participants want to know your opinion on the impact of the budget on sectors like banks, or private banks to be in particular, because that's one space which has not been delivering over this, say, the last 1-2 odd years. So do you see any positive impact over there or any improvement, not just around the budget, but the fact that rates are going to come down, and will there be some shift and pickup over here?
So Saurabh, in this budget, there's nothing specific for banking sector.
Right.
Let's see what drives banking sector. If interest rate comes down, their margin gets impacted immediately, unless until the deposit cost also comes down by similar level. Now, in my opinion, if RBI cut rates next week, chances are that lending cost will come down quickly, but borrowing cost will take to come down till such time liquidity improves. So rate cut will be good for economy, but not so good for banking sector. Point number one. Point number two, today corporate India is deleveraged and banks are not witnessing any NPA problem on corporate banking loans. This budget has given a boost to consumption. If that creates multiplier effect, there will be more capex as capacity utilization goes up. But those capex are not going to materialize in next 3, 6, 9 months. It will take some time. So banks' credit growth can improve in FY27 rather than FY26 first half. The third thing, if you look at retail loans, on unsecured loan, there were worries. NPA and microfinance were going up. Now the tax rebate is going to people who were in, and hopefully if there are any NPAs from that segment, banks will benefit. People would rather pay back bank loans on autos, on housing, on personal, rather than spend money. But the pressure on retail banking loan is coming more from non-taxpayers rather than taxpayer loan. So the benefits will be little bit less. Now, this is the fundamental side. Budget is not materially beneficial or negative for the banking sector, except in the longer term. Now, bank was the most over-owned sector. FPI's own majority of stake in HDFC Bank, ICICI Bank, and so on and so forth. They are selling emerging market as an asset class. Most liquid counter is bank. Most big investment is in banks. So that selling is likely to continue for banks, and that will keep some pressure on banking stock. So overall, I believe banking stocks looks good from a valuation point of view. If you have 3 to 5 year view, certainly this is the sector to be overweight, especially private banks who have good credit culture and who are not exposed to microfinance and unsecured lending. But don't expect a miracle from banking stocks. They are compounders, not multi-baggers.
Sure. That's interesting and very valid. Another point related to banks, and we've been seeing this trend that over the last few years, we've seen not too much money going into FDs, and they've been diverting money towards either the stock markets or other debt instruments like debt mutual funds, etc. Do you see this trend even continuing now, given that it seems that the markets have plateaued or topped out for a while, and do you see that trend changing?
So Saurabh Bhai, this is a misnomer. If Saurabh Bhai gives money to Kotak Mutual Fund deposits in Kotak Bank. If Kotak Mutual Fund goes and buys stocks in the market, it pays by check to the customers, to the seller's account. It doesn't give cash. The flows to mutual fund has zero impact on bank deposits because neither we accept cash. Left mein le lo, Arun. No one, takes money in cash. No one gives money in cash. So undoubtedly, there is no impact on deposits because of flows into debt mutual fund or equity mutual fund. I work in a bank and I have asked many of my colleagues the same question. Can you show how does money get moved from depositors to mutual funds in case there is a problem like this? None of them have been able to explain it to me. So let's remove this misconception that when investors give money to mutual fund, it is at the cost of bank deposits. Our money also remains in bank deposits only. As the markets have corrected, could there be some impact on domestic flows? My answer is no. Saurabh bhai, between FY21 to FY23, Indian savers have put 9 lakh crore in currency notes. Currency notes, घर पे जो रोकड़ा रहता है वो. The total flow into mutual fund was 4 lakh crore. मुझे तो लोगों को ये कन्विंस करना है कि साहब घर पे रखे पैसे से पैसों के झाड़ नहीं उगेंगे. म्यूचुअल फंड में डाल दीजिए, शायद एक साल नीचे जाएगा बट बाद में तो ऊपर आ ही जाएगा, रिटर्न बन ही जाएगा. सो आवर डिपॉजिट ड्रॉप is more because of currency notes in circulation than mutual fund, in my opinion. And as long as we can convince people that mutual funds can deliver better return than currency notes, and up to 12 lakh there is tax exemption, I think money will continue to come to mutual funds. Outperforming cash currency notes is not that a difficult task.
Of course. Sure. Thanks. While we are on sectors, maybe I'll take a couple of more questions before I move to the other part of the question. So maybe your quick view on defense and IT as a sector, as these two sectors, and maybe even pharma, if you could give a quick view on these sectors.
So let's talk about defense. Undoubtedly, government is increasing allocation to defense capital spending. But as you see, pension, thanks to one rank, one pension, has gone up substantially higher. And hence, there will be a challenge. In defense, another worry is that the future of warfare is changing. For example, we have seen in Russia-Ukraine war how a tank worth $200, $300 million can be destroyed by a drone of $15,000. In defense, companies which are engaged in making tanks, probably their days are numbered. Companies which are making drones, probably they have a great future ahead. So we will have to pick up defense stocks of those companies which are going into futuristic technology. Number two, on the pharma sector, obviously a lot will be driven by what US does. Many of our generic pharma companies spend large amounts of exports large amount to America. Now, if they increase tariff from 10% to 25%, there could be some dent. I hope US will not make that mistake, because we supply 40% of generic medicines to US and we just take 10% of their medicine spend. 40% volume at 10% cost. I don't think so. They should levy tariff on us. If at all, they should encourage us to supply balance 60%. Their cost will come down even more. Overall, pharma sector looks attractive from an investment point of view because valuations are reasonable. As people become rich and old, healthcare spending keeps on increasing, and Indian pharma companies are reasonably competitive. Again, within pharma, you'll have to go for companies which are investing for future. For example, if earlier medicine was given collectively at large, the future of medicine is where you deliver appropriate medicine in specific places as per the construct of the patient, your medicine could be different from mine, and going into medicines which have much lower side effects. So obviously, biosimilars, targeted delivery, customized medicine, these are all which will differentiate boys versus men's. Uh, on the IT sector, Saurabh, by clearly we are going through a big churn thanks to advancement in AI. And every company will say we are doing AI, but I have to do better than my competitor. Now, suppose if you are a 5 lakh employee company, can all 5 lakh be trained on AI? If you can do that, the productivity will probably go up 5x or 10x. Then you need to have work also for 25 lakh people or 50 lakh people. But suppose if you are just 15,000 or 20,000 employee person and you train all of them on AI, suddenly they will deliver work of 1,50,000 people or 75,000 people. Companies which leverage AI better than their peers to provide cheaper, faster, better solution will do better than companies which fail to do so. So whether it's IT, whether it's pharma, whether it's defense, invest in companies which are futuristic rather than which are becoming dinosaurs. That will be the key differentiator to make money over the years.
Sure. Point on the markets at large. We're in the middle of an earnings season. What's your view in terms of earnings expectation for the market, say for FY26 and maybe FY27?
So FY25, we will have about 5 to 6% earnings growth in Nifty. We should go to about 1050 on Nifty. And before this budget, our view on FY26 was will probably grow about 10% thanks to banking and automobile stock. But after this budget, if the multiplier effect of consumption goes through, then maybe we will see little extra earnings growth. So rounded off, you can assume earnings on Nifty 50 moving from 1050 to about 1175, 1200.
Sure. Sure. Um, One interesting question on the changes. So, if you look at the old tax regime, there were several elements of tax incentivized savings, which was sort of mandating or maybe leading or nudging people towards investing, say like ELSS. Now, the new tax regime changes could likely aid consumption in the economy, but it could also lead to a behavioral change in the newer generation of investors, where they could be more spenders and not systematic investors. Um, your view on this, and do you believe this, or do you have a different view on this?
So India is too heterogeneous to take a single call. There will be kids who will be living on credit card. There will be kids who will be investing for future by cutting down and saving. I don't think so. In a large country like India, it will be fair to generalize. Be neither disappoint optimist nor be disappoint pessimist. Matlab, the place from where I'm speaking right now, 500 meters away is a location where world's most expensive wedding happened. And 1.5 kilometer away, Asia's and world's largest slum is there. Both coexist. अब आप क्या दिखाना चाहते हैं उसके ऊपर you can justify the thing. So my feeling is that there will be some changes here and there, but both will coexist. People are financially literate. They will spend money if they are sure about the future by leveraging, and they will save money to secure their future. Both trend will coexist.
Sure. Thanks. A question which is more on Trump policies, tariffs, etc. While you did mention that during your talk, but given whatever changes we are seeing globally, how do you see the currency or INR versus the USD? Are you seeing it to come under further pressure? Do you have any range in mind in which it could move, and
So
probably how
for
its impact on RBI policy?
so for looking at INR movement, look at Chinese renminbi. Our largest trade partner is China. World's largest trade partner is China. If Chinese currency, let's say, depreciates by 10%, does rupee have a choice? It also will have to fall by 10% minimum so that we remain competitive to China. In fact, we may have to fall 12% to remain competitive with China. So fate of rupee is tied with Chinese renminbi, point number one. If they go down, we go down. There's no other option. Point number two, assuming everything outside of China, when clearly rupee will have to depreciate because our inflation vis-a-vis non-China trade partner is little bit higher. Our productivity is little bit lower. So we need 2 to 4% depreciation of rupee every year to remain competitive with our trade partners. And hence, destiny of rupee is to depreciate. And today it has crossed 87. My feeling is that rupee will continue to weaken, but in the near term, for next 6 to 12 months, more like next 6 months, keep a watch on Chinese currency, will closely track them.
Sure, interesting. Question on the new income tax bill, which is expected to be presented in the parliament, and probably will be a major step in simplification of tax laws. Any view on that? Any expectations from what we get to hear from the finance minister in the coming week?
So while I am a chartered accountant, I have been not practicing tax for last 30 years. Yesterday, I was at the World Forum of Accountant in New Delhi, where about 7,000 CS across the globe were present. And I overheard someone saying that, Nilesh bhai, please don't have hope for direct tax code. One, after introduction in parliament, it may go to JPC for consultation. Second, it will be effective next to next year, not FY26, but FY27. And number three, every government says we want to improve ease of doing business. We want to improve ease of compliance. We want to reduce regulatory burden. But when the code comes, when the bill comes, when the law comes, somehow or other, this object is not achieved. So let's not have high hopes. Let's pray that we truly get a bill which reduces ease of doing compliance.
Sure. Question on gold. Well, you did mention that. One of the participants wants to know, is it gold or silver or both? What's your view? Is silver expected to do better than gold? Or do you still prefer gold? What's the preference?
So again, Saurabh bhai, I didn't talk about silver because our knowledge on silver is very limited. See, gold, there is a clear trend visible of central bank buying. On silver, the trend visibility is coming from the consumption across various user segments. Central banks don't buy silver. If they start buying silver, silver will definitely go up. Silver is mostly consumed in electronic products and such other industry. Now, getting the demand trend of this industry is not as easy. So I will say I'm more convinced on gold's rise thanks to central bank buying. I don't have much knowledge on silver to make a comment.
Sure. Maybe one last question around budget assumptions or expectations around inflation. I mean, it seems to be fairly benign in terms of their inflation expectations for this year. But with the global factors, tariffs, Fed policies, commodity price, volatility, etc., could these assumptions be in for some disruption? And if inflation rises, for that matter, in your view, does the government seem to have a plan B?
So one, our imports are like 700, $800 billion. That's about 20% of our GDP. Now, will it have material impact if we levy tariffs on the same? Unlikely. We import 125 to $150 billion of crude. There's no point in levying tariff over there. If at all there is a case to revise down petrol and diesel prices, because globally crude prices have come down. My feeling is that inflation is likely to remain benign. The Kharif crop has been bumper at 1,650 million metric tons. Rabi crop is likely to be good. And as long as food prices are good, we should be in a good shape, which controls 45% of our CPI. 10 odd percent is housing. There's no tariff risk over there. So 55% gone. About another 10 to 15% direct and indirect is fuel. There is a case to lower, not to increase. So almost 75% of our CPI basket is not impacted by tariff. बैलेंस 25% में थोड़ा बहुत ऊपर नीचे हो गया तो कोई बहुत बड़ा फर्क नहीं पड़ना चाहिए. So I'll be more comfortable on inflation than, let's say, over currency.
Sure. Great. I don't think we have any further questions at this point in time. It was a very interesting last 45 minutes, Nilesh bhai, as ever. And I would like to extend my gratitude for having taken the time out and for having shared your insights with us and making it very simple and sort of relatable to how we could understand the budget and its impact on the market. Big thank you to all the participants as well for having come on this call on a Monday morning and to have devoted your time for this. So we appreciate your time and look forward to connecting again. Thank you, Nilesh bhai, once again, and thank you for the team
Thank you.
for having helped organize this. Thank you, everyone. Have a great day. That's all we have. Thank you.
Thank you. Bye.
Bye.